The year 1929 stands as a watershed in economic history. In the United States, the Roaring Twenties had brought a sense of exuberance and prosperity. The economy was flourishing, unemployment was low, and new technology, such as automobiles, radios, and household appliances, were transforming daily life. Investors poured money into the stock market, convinced that share prices would continue to rise indefinitely. That heady mix of easy credit, speculative fever, and technological optimism led to one of the most catastrophic collapses in financial history, the crash of 1929, which ushered in an era of severe economic turmoil known as the Great Depression. Over the course of the next decade, the world witnessed widespread unemployment, bank failures, political instability, and social upheaval on a scale rarely seen before. Today, we revisit that dramatic period to better understand the causes, consequences, and lessons of the crash of 1929 and the Great Depression. During the 1920s, the American economy experienced a surge of growth driven by technological innovation and a general sense of post-World War I optimism. Factories churned out consumer goods at a brisk pace, enabling ordinary people to buy items that had once been considered luxuries. The country also benefited from its status as a major creditor to war-ravaged European nations, many of which looked to the United States for loans to rebuild shattered infrastructure and pay war debts. Rapid industrial expansion, combined with easy credit policy, fueled a belief that the prosperous times would last indefinitely. Within this context, the stock market became a magnet for all sorts of investors, experienced financiers, bankers, middle-class professionals, and even small-town teachers or farmers who knew little about company fundamentals. The popular practice of buying stocks on margin, which meant paying only a fraction of a stock's price and borrowing the rest, allowed individuals to control large amounts of shares with relatively little upfront cash. This worked brilliantly as long as share prices rose, since investors could sell for a profit, repay their loans, and pocket the difference. But if prices started falling, margin buyers could be forced to put up more money or liquidate their holdings quickly. By mid-1929, warning signs emerged that the market had become overheated. Company valuations soared far beyond their real earnings potential. In some cases, investors threw money at ventures that existed mostly on paper, with little actual business behind them. Authorities and financial experts cautioned that prices were unsustainably high. Nevertheless, the public's appetite for speculation persisted. Many believed that the continuous rise in stock prices represented a permanent shift in the economy, a sign that old rules no longer applied. In September 1929, the market showed initial tremors. Share prices wobbled and then stabilized, but the ominous signs were there for anyone who cared to read them. On October 24th, later dubbed Black Thursday, the dam broke. A massive wave of selling hit the New York Stock Exchange. Panicked investors rushed to unload their stocks, causing prices to plummet. Banking leaders attempted to restore confidence by publicly purchasing large amounts of shares, temporarily halting the rout. But the respite was brief. The following week, on Black Monday, October 28th, and Black Tuesday, October 29th, panic reached a fever pitch. The market collapsed under the weight of relentless sell orders, wiping out billions of dollars in wealth almost overnight. Scenes from the trading floor showed frantic brokers, as well as stunned investors who had lost their life savings in the blink of an eye. The crash of 1929 did not single-handedly cause the Great Depression, but it acted as a catalyst that accelerated weaknesses already present in the economy. The underlying problems included overproduction in agriculture and manufacturing, stagnant wages for many workers, high levels of consumer debt, and a fragile banking system. Farmers had been experiencing difficulties throughout the 1920s, partly because global demand for agricultural products had dropped after the war, leaving them saddled with surplus goods and shrinking income. With their profits squeezed, farmers became less able to purchase the very goods that factories were producing in abundance. This dynamic foreshadowed a broader demand shortfall throughout the economy. As stock prices continued to spiral downward, banks that had lent heavily to speculators began to falter. Banking regulations at the time were minimal, and many smaller banks lacked diversification. When large numbers of customers lost confidence and rushed to withdraw their money, banks ran out of funds, leading to a cascade of closures. People who thought their deposits were safe discovered that their savings had vanished. Fear spread, prompting even more bank runs. The phenomenon was self-perpetuating. If a bank's clients, alarmed by rumors, withdrew all their funds at once, the institution quickly became insolvent, regardless of its underlying asset. By the early 1930s, thousands of banks across the United States had collapsed. Business credit dried up. Companies could no longer borrow to expand production or finance day-to-day operations. Layoffs soared, and consumer purchasing power collapsed, setting off a vicious cycle of reduced spending, decreased production, and rising unemployment. The Great Depression soon became global. European nations, which had borrowed money from the United States, found themselves unable to repay their loans as American banks cut back lending and demanded repayment. Exports fell in both directions. Protectionist policy, such as the Smoot-Hawley tariff in the United States, worsened the situation by stifling international trade. Countries raised tariffs in retaliation, causing a dramatic drop in worldwide commerce. Industrialized nations faced a slump in manufacturing, while agricultural nations faced plummeting crop prices that often did not even cover the costs of cultivation. Economic hardship became the norm. Unemployment rates soared in the United States, Germany, and beyond, at times reaching 25% or higher. Britain, France, Canada, Australia, and many other countries suffered from deep economic contraction, bankruptcies, and a general sense of despair. In the United States, the Hoover administration initially tried to reassure the nation that the crisis would be temporary. However, the Depression's roots proved far deeper. President Herbert Hoover believed in limited government intervention, urging businesses to maintain wages and volunteer in relief efforts. These measures failed to stem the tide of rising unemployment and bank failure. As breadlines and shantytowns, often called Hooverville, spread across major cities, public sentiment turned against the administration. By 1932, Hoover faced a disillusioned electorate in the midst of worsening conditions. That year, Franklin D. Roosevelt won the presidential election with a promise of a New Deal for America. Roosevelt took office in March 1933, amid ongoing bank collapses and social unrest. Almost immediately, he declared a bank holiday to halt panic withdrawals, allowing officials time to inspect and reopen only the banks judged solvent. This step, combined with the introduction of federal deposit insurance later on, restored a measure of public confidence. His New Deal legislation represented a profound shift in the relationship between government and economy. Programs like the Civilian Conservation Corps, CCC, the Works Progress Administration, WPA, and the Public Works Administration, PWA, put millions of unemployed men and women to work on projects ranging from planting trees and building roads to creating murals in public buildings. Meanwhile, the Agricultural Adjustment Administration, AAA, attempted to stabilize farm prices by paying farmers to reduce output. The idea was to curtail overproduction and bring supply back in line with demand. Additional reforms took aim at preventing future financial catastrophes on the scale of 1929. The Glass-Steagall Act separated commercial banking from investment banking, reducing the chances that ordinary depositors' money could be gambled in speculative markets. The Securities Act of 1933 and the Securities Exchange Act of 1934 established guidelines for stock offerings and created the Securities and Exchange Commission, SEC, to oversee financial markets. These measures sought greater transparency, aiming to ensure that investors were not misled by fraudulent claims. Roosevelt also ended the gold standard for domestic transactions, giving the Federal Reserve more flexibility to manage the money supply. Despite these efforts, the recovery proved slow and uneven. The Depression dragged on through the 1930s. Some historians argue that Roosevelt's policies averted an even deeper catastrophe, while others contend that the measures were incomplete or at times contradictory. The Second New Deal in 1935 introduced Social Security, providing retirees with a safety net, and strengthened labor rights through the Wagner Act, which encouraged union organization. Yet unemployment remained high, and many Americans continued to struggle. The Dust Bowl, a devastating environmental crisis that hit the Great Plains states, drove thousands of farm families westward in search of work, adding another layer of hardship. Internationally, the Great Depression strained societies to the breaking point, contributing to the rise of extremist political movements. In Germany, the economic crisis helped fuel public discontent that allowed the Nazi Party to gain prominence. In other countries, there were surges in communist, socialist, or right-wing nationalist movement, all proposing radical solutions to economic woes. Democracy itself faced challenges in places where joblessness and hunger eroded faith in traditional institutions. Economic historians still debate the extent to which World War II, rather than the New Deal, finally lifted the United States out of the Depression. When the war began, government spending on weapons, equipment, and the mobilization of troops expanded production and drastically cut unemployment. Factories ran at full tilt to meet wartime demands, and the entire economy was reoriented toward supporting the conflict. While this surge in activity effectively ended the Depression, it came at a monumental human cost overseas and set the stage for a post-war order dominated by the United States and the Soviet Union. From a longer-term perspective, the crash of 1929 and the subsequent Great Depression reshaped attitudes about finance, government intervention, and global economic system. In the United States, many of the regulatory structures that emerged remained central to the financial landscape. People became more cautious about margin trading and speculative excesses. Regulators developed tools to mitigate bank panic, including deposit insurance and more rigorous oversight of lending practices. The crisis also underscored the interconnectedness of global economies, a lesson that has repeated itself in subsequent financial downturns. Even today, the specter of the Great Depression looms large whenever a major recession or financial crisis appears. Policymakers invoke the lessons of the 1930s, stressing the need for decisive action to restore confidence. Economists study the array of factors, monetary policy, fiscal stimulus, trade barriers, that can worsen or alleviate an economic crash. Ordinary citizens remain aware, on some level, that unchecked speculation and inadequate safeguards can bring about a chain reaction of events that devastates entire communities. The crash of 1929 and the Great Depression also left a cultural legacy. Photographs of men in soup lines and families living in shantytowns remain seared into the collective memory, a stark reminder that the prosperity of the Roaring Twenties was fragile. Literature and music of the period, from John Steinbeck's The Grapes of Wrath to Woody Guthrie's folk songs, captured the despair and resilience of a generation forced to adapt to unimaginable hardship. Public works projects commissioned by the New Deal shaped the American landscape, constructing roads, dams, and parks that endure to this day. In reflecting upon the events of 1929 and the decade that followed, one is struck by how an era of seemingly endless optimism could give way to widespread hardship and global instability. The crash of 1929 was not merely an isolated market event, but rather the tipping point that set off a complex web of economic failures. The lesson remains that financial markets, like any human endeavor, are susceptible to emotional excess. Booms can lead investors to neglect fundamentals, while busts can spiral into deep recessions if key institutions fail and public confidence collapses. In the wake of such a crisis, the role of government often expands, as communities demand collective action to restore stability. The Great Depression finally receded with the onset of wartime production in the early 1940s, but the scars it left were profound. Generations that lived through it became careful savers, wary of credit and suspicious of speculative booms. A stronger sense of social responsibility emerged in some quarters, fueling debates about how best to protect the vulnerable in an economic downturn. The echoes of this era still reverberate in modern discussions about economic policy, wealth distribution, and the balance between private enterprise and public oversight. Ultimately, the story of the crash of 1929 and the Great Depression serves as a cautionary tale about the perils of unbridled speculation, the fragility of the banking system, and the need for robust economic safeguards. It also offers a testament to human resilience. Despite the hardships, people found ways to adapt, to organize, and to demand changes that would shape the world for decades to come. Understanding that period in history is not only an exercise in looking back, but also a means of recognizing patterns that may re-emerge. While no two crises are alike, the human forces of fear, greed, hope, and resilience remain constant. The lessons of 1929 are as relevant today as they were nearly a century ago.